Welcome back to another episode of the Christian Kirkley Show, and today we are going to be talking about faith and risk. So, with risk taking in anything, you have to have faith, right? If you have an open position in the stock market right now, you're seeing that you need to have faith, right? Because there's a lot of fear going on in the markets. So one thing that I try to tell myself time and time again is just faith over fear. Really, there's no need to fear. I really like the quote by Franklin Roosevelt: "The only thing we have to fear is fear itself." If you study history, you can see that there are plenty of times where there are recessions. The most millionaires are made during recessions. Recessions are excellent buying opportunities. With all the tariff craziness going on right now, it's out of our control. There's nothing we can do about it except educate ourselves. That way we are going to be able to take action whenever the opportunity strikes. If we aren't educated and we aren't well capitalized because we haven't saved or we haven't made extra money to be able to take advantage of an opportunity, then we are at a disadvantage, right? So things can get a lot worse or they can get better. Really, there's no need to stress out and fear about it, because if you have faith that everything is going to be okay, it will. There's been a lot worse times. I mean, if we go back to the Great Depression, people lived through that. You go back to World War II, you go to COVID, look at the quarantine. Like, that was brutal. So really, the point of this video is to talk about faith over fear. And with risk taking, you have to have faith. If you're going to pursue a life of financial freedom, you're going to have faith in your risk taking. You're going to have faith in God. You're going to have to let go and stop trying to control everything. And I'm speaking to myself right now. That's one reason I like this podcast, is because I'm able to put out my thoughts and reflect on a lot of things. And I've been, of course, worried about the market and all these other things going on right now. But then I realized over the weekend, I went to this awesome concert called Life Surge, and it talked about a lot about financial freedom and putting faith in the Lord with your finances, right? If you hold on to something really tight, and you try to pursue after something that is not in your control, then you're just going to be really stressed out. So with your finances, just be a good steward of them. And other than that, you can't control the economy. You can't control the market. So yeah, just save money, make extra money, and then whenever good opportunities come up, take advantage of them. I mean, look at Google stock, look at Microsoft stock. You're going to probably start seeing some really good deals on real estate. I'm already seeing it now. A lot of our offers are a lot more competitive now. It's becoming a buyer's market. It's been a seller's market almost since I've been a grown-up. I turned 18 in 2017, and then so I just turned 21 when COVID hit. So I mean, and I was in the Navy. I wasn't even thinking about real estate like that until around the end of that. But it's been a seller's market for so long that it's time for a change, and we're starting to see that change. It's starting to go from a seller's market to a buyer's market with real estate. One cool stat is usually in a market that has about 70 days on market for the house, that is a good equilibrium, right? And what I mean by that is if you have anything less than 70 days on market average for a house, then it is a little bit more of a seller's market. But if it's 70 or more, then it starts to become a buyer's market. So that 70 range is a good equilibrium. And in Huntsville, Alabama, for example, we're still in the 40s days on market. So it's still a strong market overall. And that's the thing, like with recessions, it hits some areas a lot harder than other areas. Like places that have been fueled by what Alan Greenspan of the Federal Reserve in the 90s called irrational exuberance. Everything that has been fueled by that irrational exuberance is crashing. Nashville, Miami, probably Vegas. I'm not sure. I'm gonna guess Vegas. I think that their prices have been coming down pretty hard over the last few years. Generally, those are the markets that do this and then come right back down. They shoot up and they shoot right back down. Same with stocks. If you look at some of these unprofitable companies that just had crazy increases, and people were gambling on them and betting that they would continue to go up even without profit. They crashed. And Warren Buffett has a good quote: "Is you find out who's swimming naked whenever the tide pulls in." So a lot of people have been swimming naked. You've got a company that is negative in profits and barely having any revenue just because they have a good idea, and they skyrocket, like some of these quantum computing companies and a lot of these AI companies. The AI bubble is popped, and now you can't just have a crazy valuation just because you have a good idea. Those ideas or those types of plays work whenever it's a risk on market. So there's risk on markets and there's risk off markets. We are now in a risk off market. People are buying the Japanese yen. People are buying the Swiss franc. People are actually selling the dollar, surprisingly enough. I do see the dollar probably doing a turnaround towards the end of the year because of tariff strength. You got to remember, tariffs haven't actually been implemented yet. The China tariffs are implemented tomorrow, I believe. So that is what's going to start making a stronger dollar. We haven't gotten there yet. The dollar has been going down actually because of recession fears in the U.S. And the Federal Reserve actually met today to talk about a potential emergency rate cut. Rates were actually only predicting one cut of 0.25 for the entire year before this market shock. Now we're actually thinking there's going to be a rate cut in total of 1.25. So 5 quarter point rate cuts throughout the year is now what they're predicting. There's a 60% chance of that. Before it was like a 10 or 20%. So right now, Jerome Powell is saying we're fine. Jerome Powell is the head of the Federal Reserve. He's saying we're fine, but Trump and a lot of other people are pushing back saying, hey, give us a rate cut. And we have a lot of wiggle room. I was talking about this the other day. 2009 and 10 were scary because we had cut rates drastically and got down to 0%. We couldn't stimulate the economy anymore from there. We were already at zero. So you can't really go any lower than that. Right now we have a lot of room to go down with stimulus. So think quarantine with 2020. I believe rates were 4 or 5%. They're actually around 3 or 4% in 2019. And then whenever the quarantine shock hit, the Federal Reserve cut rates down to either 0.25 or zero, in between 0 and 0.25. Anyways, they cut them near zero, and that skyrocketed the economy. I mean, if you look at the market today, we actually had a big jump there for a moment whenever the market found out about this emergency meeting, because the Fed is going to inject liquidity money into the market to save bonds, and eventually they're probably going to start doing quantitative easing again, which quantitative easing is just the Federal Reserve buying assets. So think Apple, Microsoft, all these different assets, and that skyrockets stock prices in the economy. It's exactly what happened in March, late March of 2020. We were panicking, and then the Federal Reserve hit their money button, and we skyrocketed. So the Federal Reserve can cut by a whole point at the next meeting if it wants to. Jerome Powell is probably not going to do that because he doesn't want to see higher inflation. The Fed's job is to control unemployment and inflation, not to control the stock market. They can do things to stimulate the stock market because they don't want a recession, because falling asset prices to a certain extent will cause unemployment. So they'll do things to make sure that unemployment doesn't get too crazy. But then if inflation gets crazy, like 2021, 2022, then they've really shot themselves in the foot. They've been working really hard to keep inflation low, and they've done it. So the last thing that they want is to cut rates really fast and inflation to skyrocket. Right. So pretty much my point with inflation and rate cuts and the interest rates are we do have wiggle room. If things get bad enough, the Federal Reserve can and will cut rates. They do it all the time. They literally talked about it today with an emergency meeting. And in that case, it's going to be excellent for real estate because we're going to get lower rates than the rates have already been going down, which has been great. So there really is still a lot of breathing room here. And what I'm going to do, as soon as they announce a larger rate cut than anticipated, I'm going to buy a ton of discounted stocks, right? I think that a turnaround is right around the corner. It's going to be rough, yeah. And let's go ahead and speak on tariffs now that we're talking about it. So I think that overall the tariffs are going to hurt in the short term, but it's going to be positive for U.S. jobs and American manufacturing. The reason for that is because it's going to be more expensive for people to buy things overseas and import overseas things like steel, cars, etc. So that's going to stimulate American jobs by incentivizing individuals to open up U.S. production. So, for example, if I'm buying my steel from my steel building company from China and it just got 50% more expensive, I'm going to be incentivized to buy steel from down the road from Bob's Steel that just set up shop, right? Bob's Steel is going to take a couple of years to set up. So it's a long-term play. It's going to hurt in the short term, yeah. And there's going to be a lot of negative repercussions, but every coin has two sides, right? So you gotta look at the positives too. It's gonna hurt, and yeah, there's gonna be a lot of choppiness and fear and anxiety, but we can't only look at the negatives. That's what happened in 2009 and 10 when people were only looking at the negatives of the Great Recession, and they had their blinders on and they were stuck in survival mode, which I understand. But you have to change from that scarcity mindset to the abundance mindset. If you're constantly in scarcity survival mode, you're not going to be open to the opportunity flow to take advantage of opportunities. Remember the stat earlier, the most millionaires are made during recessions. You could lose everything today, and let's say you start off tomorrow with zero and we're in a deep recession. Well, no one can take your education. No one can take your mindset from you, your personal development, your connections. That's why millionaires make their money back so quickly after going bankrupt, is because it's 80% who you know, not what you know. But that 20% what you know does help. So, recession blueprint, right? Work more than you normally did, build up a cash bundle, don't have everything in the market. That way, when the market drops, you can actually buy cheap assets. Don't sell. That is the worst thing you can do during a market downturn is sell. Have faith, hold on, study history, realize that over the long term, these things work out. It's just a blip in the road. It's going to be painful, yeah, sure, but just have a long-term perspective. Delay your gratification, expand your time horizon. The longer you can expand your time horizon, the more successful you are going to be, and just bet on yourself. Don't listen to the news, don't listen to other people's fears. Just have faith in God that He will provide. Bet on yourself, keep pushing forward, and don't give up. Thank you for listening, and don't forget to enlighten and empower. Let's go.